Let's talk about stock valuation, trying to figure out how much we should pay for a share of stock. We'll look at a few theories for common stock and we'll look at a theory for preferred stock. First of all, what does it mean to own a share of common stock? It means you own part of the company, so you have a claim on income. So as the company makes money, you have a right to some of that money. Unfortunately, you're not first in line. The debt holders, the people that lent money and provided services to the company, have the first claim on the money, and preferred stockholders, if there are any, have the second claim. But you as a common stockholder have a claim, it's just that you're last in line. Same thing for assets. So when the company closes up its doors and sells its assets, you have a claim to whatever's left at the end. Most importantly, probably, you have voting rights. So you can vote for the board of directors who hires the officers, and then hopefully you inspire the officers to do their best to raise the price of the stock, because that's what you're interested in, is an increase in your stock price. So hopefully your board of directors gives a compensation package to your officers that encourages them to increase the price of stock. Okay, let's look at a couple theories about what people should pay for a share of stock. Suppose I buy a share of stock at time zero. I anticipate getting a dividend, let's say at the end of the first year, and then selling the stock. Well, when I sell it at the end of the first year, what's that guy going to pay me? Well, he anticipated, say, holding on to it for 2 years and then selling it. And that guy, maybe he said, I'm going to hold it forever. So he's just going to collect the dividends. Whatever the case may be, the actual price that we should pay for a share of stock, this theory argues, is the present value of the future dividends, because that's what we're buying when we buy a share of stock, is a dividend stream. So we might look at the history of a company before we buy the stock at time zero. And if it's got a flat dividend, we'd find the present value of that future flat dividend by taking that dividend and dividing it by our required rate of return. Say our required rate of return is 13.5%. We take that dividend and divide it by 0.135, because a flat dividend is an annuity in perpetuity. And remember, the present value of an annuity in perpetuity is simply that annuity divided by the discount rate. But no one buys a share of stock because they're expecting a flat dividend. If you want a flat amount paid back, put your money in the bank, buy a share of preferred stock. So when you buy a share of common stock, you're hoping that the dividend's going to increase. So what you might do is make some predictions about these future dividends and then use the CF menu on your financial calculator and plug those in and find their present value at your required rate of return. Or if you're a glutton for punishment, you might remember that the formula for present value of a lump sum is the future value over 1 plus I, that's your discount rate, raised to the nth power. And so you might use that formula to find the present value of all those predicted future dividends. And so this would be 1 plus your required rate of return raised to the second power, 1 plus your required rate of return raised to the third power, et cetera, et cetera, et cetera. But one of the cool things that we like to do in finance class is to talk about a constant growing dividend. So there's this kind of cool shortcut that says take the dividend of the next period, divide it by the required rate of return minus the estimated growth rate, and that'll give you the present value. That'll give you the price you should pay. So that's where we're going to end up here. So the next 45 seconds may lose you, but remember, this is where we're going to end up. The price of a stock under this theory is the next dividend, not this year's dividends, next year's dividend divided by the required rate minus the growth rate. So here's the formula. The price we should pay, the present value times zero, is the dividend at the end of the first period divided by 1 plus R, that's finding the present value of that, plus the dividend of the second period brought back to present value, 1 plus R, divided by 1 plus R squared, plus the dividend of the third year divided by 1 plus R cubed. And so that's the sum of these guys here. Well, what's another way to say the dividend at time one? Another way to say the dividend at time one is the dividend at time zero, today's dividend, times 1 plus the growth rate. That grows it at, say, 1% or 2%, whatever we think G is. And another way to say the dividend at time two is the dividend at time zero grown by 2 years. And dividend at time three is the dividend at time zero grown by 3 years. So now that we've figured out a way to express the dividend at time 1 and 2 and 3 and 4 in terms of the dividend at time 0, we'll go back and substitute that new term. So instead of dividend at time 1 divided by 1 plus r, we'll use dividend at time 0 times 1 plus g divided by 1 plus r. Instead of the dividend at time 2, we'll say the dividend at time 0 times 1 plus g squared. We'll divide it by 1 plus r squared, etc. And that mess will simplify down to the dividend times 0 times 1 plus g over the required rate of return minus g. We know that the dividend times 0 grown by 1 year is the dividend time 1. So now we've got that formula that I promised you. The price we should pay for a share of stock whose dividends are expected to grow at a constant percent per year is the dividend at time 1 divided by the required rate of return minus the growth rate. So that's kind of cool, but where do we get the required rate, or sometimes called the expected rate of return? And we get it from the capital asset pricing model. So it looks confusing, but it's really not as confusing as the numbers make it seem. Suppose there's a risk-free rate. In this example, it's 5%. So I've got all my money tied up in treasury bills with the U.S. government. And I meet somebody at a cocktail party and he says, you know, you've got no risk, but you're only earning 5%. If you let me manage your money for you, I'll put it in the stock market and I'll earn you 12%. That's 7% more than you're making. Well, that's not enough to induce me to enter into the stock market. I need a premium, based on this example, of at least 8.5%. The risk-free rate may be 5, but I want to earn at least 13.5. So another way to express that premium is the market rate of 13.5 minus the risk-free rate of 5 means I need to earn at least 8.5% over my risk-free rate for me to even think about entering into the stock market. And when we start talking about specific stocks, if they have a beta greater than 1, in other words, if they move more than the stock market, I want to increase that premium by that amount of the beta. If it's less than 1, if it moves less than the stock market, maybe I'll accept a little bit less. So this formula down here says the expected return or the required return equals the risk-free rate, in this case that's 5%, plus beta, in this case suppose the stock has a beta of 1, times 13.5 minus 5. 13.5 minus 5 is 8.5. So the required rate of return is the 5% risk-free rate plus 8.5% is 13.5%. Like I say, if the stock had a beta of 2, we'd be out here on the graph, and we'd need a much greater return for me to be induced to invest in that particular stock. So let's come back here and do a quick problem. Let's say we have a stock that currently is paying a dividend of $1 per year. We estimate its dividend growth rate to be 1% per year, and our required rate of return is 13.5%. D1, the dividend the next year, is going to be $1.01 because it's grown by 1%. We're going to divide it by the required rate of return, which is 0.135, based on what we just figured out, minus the growth rate, which is 0.01, which means that our price of our stock should be 1.01 divided by 0.125, or $8.08. Another theory is the price-earnings ratio valuation model. Remember, price per share over earnings per share is the PE ratio. And I think about this like real estate. So if your neighbor's house looks just like your house and his house just sold for $750,000, you have a pretty good idea that your house is worth $750,000. Well, if there's another company in your business that's very similar to you and it has earnings per share of $1 and it's trading at $12 a share, that means their PE ratio is 12 to 1. So if you have 67 cents in earnings per share, you apply that same PE ratio, 12 times 0.67, gives you $8.04 per share. And please keep in mind, these are all just theories. There's also another theory out there about behavioral finance that says that people aren't rational and that they hold on to stocks longer than they should and they sell them sooner than they should. And so that all these rational models are interesting but don't really reflect the stock market. Finally, let's look at preferred stock. Remember, preferred stock has a dividend percentage somewhere in the corner, somewhere on the share of stock. And so that says to the world, if you buy a share of our stock, we promise to make that percentage payment to you every year, assuming that we can. We're going to do our best. So if you had a $100 preferred share of stock with a 3% dividend, that means the company is saying to you, if you pay $100 for the share of stock, we promise to pay you $3 a year. And of course, the stock trades out there in the secondary market, and sometimes people buy it for more than $100 or less than $100. And how do they figure that out? Well, remember the present value of perpetuity, annuity in perpetuity, is simply the payment amount divided by the discount rate or the required rate of return. So when we first buy this stock, it's $3 per share is the annual dividend. That's 3% times 100. And if our required return was 0.03, $3 divided by 0.03 means a sales price of $100. But suppose interest rates go up, or suppose the credit quality of this company goes down. So when I go to sell that share of stock, somebody requires a 4% return. So $3 divided by 0.04 means that now the price of that stock is down to $75. So the price of a preferred share of stock should be the dividend divided by the required rate of return. So these are by no means all the theories about how stock gets valued, and they are just that, theories. There's behavioral science that says that we aren't rational beings and we buy and sell stocks when we shouldn't. The constant dividend growth model is based on the fallacious assumption that a dividend is going to constantly grow at a certain percentage, and that the required rate is always going to be bigger than the growth rate. That may not always be the case. So these things are all flawed, but they should give you a good idea of some of the ideas about how stock gets valued.